Hello, everybody. This is Dave Palamar again. This is the fifth, the final of our financial literacy program. I hope you all have found it useful, uh, worth it to review each of the five. There's some over or re-emphasizing of points, but they are very distinct and very important each in their own way. And today's is savings and investment, which I find to be extremely interesting and critical. Maybe because I had absolutely no money at all until my mid 30s, and I just can't get over the power of the compounding of money and how this can help you in your future. So anyway, page one, here we are. That's me. That's what I look like. I grew my hair in a ponytail when I get out of the army, and I keep it like that because I prefer it that way. I was an army veteran, or I am an army veteran. I was in tanks. That is an M1 Abrams tank right there. I was in before those were deployed, so we use M60A1s. Please allow me this disclaimer. I will summarize that I'm doing this and I'm trying to help you to the best of my knowledge, but I will not be held liable if someone says, hey, there's an inaccuracy here, or I did what you said and it didn't work out. I know what I'm talking about. I've been in this business for over 30 years since leaving the Army, but I'm doing this as a volunteer and I'm trying my best, and I'll not be held liable or suggesting that I'm a licensed teacher or anything. Anyway, let's move on. Let's get to this material. Savings and investment. Okay, so in part one, we talked about financial overview, which was a broad spectrum, just a whole bunch of things to think about in your financial life. Number two was banking and your relationship with the bank, and why that's kind of important. It's just an important thing to have a financial signature in business or in your adult life. Number three, credit like credit cards, credit mostly like your credit score, and why you need a good credit score, or whether or not you want a good credit score, and what it all means, and how to keep it clean. Budgeting, which I also love because I have clear memories to 1982, sitting on the floor of my bedroom in Radcliffe, Kentucky, and starting out my budget. And you have to get your expenses lower than your after tax paycheck, low enough that you can invest 10 or even up to 20% of your paycheck into your future, and you fill your buckets. And actually, our buckets, I'm moving to the next page here, savings and investments. We always talk about buckets. We always talk about asset allocation. I worked in the investment business, and people say, oh, what should I invest in? I have some money. And actually, my first response to that is, if somebody answers that, you shouldn't you shouldn't take their answer because a person can't possibly give you good investment advice without understanding uh, your personal situation as far as how much money you have, future money you're going to have, what your expenses are, what your obligations are, your risk tolerance, and all this. So don't ever take an investment tip from somebody. First of all, if they know something, it's illegal. But even if they're recommending something, it has to be a thorough analysis of your financial situation to see what is prudent for you. So I will not ever read the bullets to you, but I'll go through them. So pay yourself first. One time I went to a presentation, and it was from a financial firm. And at the end of it, they gave like a little poker chip. And at the end of it, they said, get around to it. And people say, I'll invest when I get around to it. And they gave everybody around to it. And they said, okay, go invest. They wanted us to invest with them, but it doesn't really matter who you invest with. Where you invest the money is important, and it has to align with your monetary needs and goals, and a whole host of things, some of which we talked about in the budget block. But the point is now. And I mean, like now. I mean, if you're listening to this live, or if you're listening to this recorded, the minute you're done listening to it, invest like right away. Preferably, you'll invest 10% of your income, maybe more, if you can afford to do it. And again, we don't worship money. I worship God. I don't worship money, but I've been poor as an adult. Oh, I guess I forgot to tell that to you. My background, my entire family was military. Almost everybody was enlisted. Everybody did one tour. Nobody was a careerist. My mother, my father, my aunt, my three uncles, brother, brother-in-law, and me. I applied to one college. I applied to military college. I really thought I was going to be a cop or a plumber, but my mother said, "Please go to college." I said, "Why?" I had no interest, but I did. So there it goes. I ended up being armor. And when I left the armor, I went straight into finance, and that was 1987. So I've been doing financial markets, and I do have an MBA in finance from a decent school. So I think I know what I'm talking about. But anyway, I borrowed all that money to go back to school. I had a negative net worth until I was 36, and it was not from gambling. It was because it cost so much. And I received my paycheck, and I tried to invest as much as I could towards the 10%. But I also prioritized paying off my debt. So I wanted to pay off my debt. I wanted to have a clean balance sheet. So anyway, my family, my context is I come from working people. My father did not graduate high school after World War II. He worked in the New York City subway for 37 years. Anyway, back to paying yourself. It doesn't matter how young you are, how small amount of money it is. Your target is 10% or more of your income, but I'd rather have you do something than a little bit. The time value of money, what that means or what that refers to is that your money is in investments, and say you have $100 and $100 earns 5%. Well, then after that, let's call that after a year. So you're not investing $100. You're going to invest another $100, but instead of investing $200, you're investing $205. And then the $205, might be 212, but of course you're going to put another 100 into it, so it's 312, etc. So the point is, the time value of money is the remarkable miracle. Well, it sounds religious. God is a miracle. Money is not, but it's just remarkable the way money grows and compounds. And I'm going to show you some charts that I find astonishing. So talk about assets, versus liabilities. By the way, the bad news, like I talked last time about credit card debt, it grows at the same rate. When you have a liability and you owe credit card debt, it grows at the same rate for the same reasons, because of the same interest rate as your investments grow. That's why it's important to be as debt-free as you possibly can. Most people have to borrow money to buy their home. The good news is the interest on the loan is deductible, as are a good amount of the real estate taxes. But credit card debt, not deductible, eating a hole in your financial situation. Now, also, people would be happy if they earn 6 or 7% on their investments. Credit card debt charges twice as much as that. That's how much your money that you owe is growing. So, excuse me, we're going to talk about dollars cost averaging in another slide here. So what are the fundamentals? So the fundamentals are like asset allocation, which we talked about in budgeting, but this is savings and investment block. So asset allocation is investing your money in different maturity buckets in accordance with when you're going to need it. Now, we talked about the emergency fund, and in the budgeting block, we said, take your entire expenses for the year, January, February, March, always take it for the year, because every month is different. Maybe in the winter, the heating bill is higher, or in the summer, if you have air conditioning on, or maybe you get an insurance bill quarterly. Just take the average, like the 6-month average, a half a year's worth of your expenses. That is your emergency fund bucket. That is the first bucket that we fill. So I'm gonna go through this again real briefly, which we did in the budget class, but I'll do it cool. Every time you get paid, you should take at least 10% of that money and invest it. The way you invest it is, think of buckets. Bucket is your emergency fund. The second bucket is short term. Maybe that's 1 to 4 year, 1 to 3 year. Then the medium bucket, 3 to 10 years. This is money you're going to need within 3 to 10 years. Long term, And for the younger people, even an additional retirement bucket after that, long term might be 10 to 30 years. You take that money that you get every time you get a paycheck and you fill those buckets, maybe a little bit to each. Frankly, I would fill the emergency bucket right away. And the emergency bucket, again, is if you lose your job, you get hurt beyond what workers' comp will pay and all this stuff, you need to fill your emergency bucket because, companies close, people get fired, people get laid off, even the government shuts down once in a while, company goes on strike, etc. Anyway, asset allocation is taking your investments and your contributions to your investments and laying them out in a form in this bucket form. And the reason you do this is the shorter the time period, the nearer it is, the sooner it is that you need that money, the more conservative it has to be invested. I would think a rule would be if you need the money within 5 years, it does not go in the equity market. It does not go in the equity market. Your mortgage payment does not go in the equity market. If you have a kid who's a junior in high school, that money does not go in the equity market because equities, I think, and you can find proof of this, are always going to outperform, but they're volatile, just like we're seeing right now today. People say to me, "Oh, well, what are we going to be in 6 months?" I don't know. I mean, the tragedy in Ukraine, COVID, inflation, and the Federal Reserve's response. I mean, some of these things are just really, and global supply chain, what's happening in China. Who knows what's going to happen in the next few months? I feel pretty confident that in 5 years, equities are going to be higher. That is my opinion, but I feel that, and that's how I invest my money. Anyway, asset allocation is allocating your investments in accordance with how soon you will need them, and the sooner you need them, the more conservative they have to be invested. Diversification. We want to diversify. We want to diversify across asset classes and within asset classes. Commodities, small, medium, large size companies, even debt, depending on how conservative you are, different kinds of debt. Time horizon. This is when you're going to need the money until when you need the money, and the entire thing, you overlay your risk tolerance. Some people are riskier, some people are like to take a little more chances. But remember, you shouldn't invest money that you need within 5 years. It should not be in equities. So we also talk about tax advantage and employer-sponsored retirement programs. We talked about this in budgeting. So a 401k is a program where you can invest money before it gets taxed. And in some cases, some employers match the first percentage, 4%, 6% that you invest into that. And there's a federal limit. It's something like 24,500, something like that. And I suggest you maximize your 401k if you can. If you can't maximize it, but if your employer matches any portion of your contribution, at least try to do the portion that they match. Individual retirement accounts are in addition to your company's 401k plans or employer-sponsored plans. Some people have plans where they can receive a bonus or something, and they can defer receipt of that bonus. And it just kind of depends on the employer. But in an individual retirement account, anybody can do these depending on your income, depending on what kind of plans you have at work. Some of these are deductible, such that you can take a deduction for the contribution, or some of these you can invest the money after it's taxed, but the tax on the gain is deferred until you take it out. And then, of course, one that is super present these days, it hasn't been around a real long time, is a Roth. And that's when you take after-tax money. Again, there's limitations depending on how much you earn, but you put the money into the Roth and it's after-tax money and it's never taxed again. Frankly, I think that's a pretty good idea if you qualify for it. So, retirement planning and deferral of income. This again is related to the 5 buckets that, because of the power of accumulation of interest and the time value of money, you probably, within those 5 buckets, they're all important. There's no way to talk about it. They're all important. If you're like 20 years old, I don't know, maybe you're going to buy a house in 3 years. Maybe you're going to buy a house in 7 years. So the 7 years is your median bucket, right? So, the 3 to 10 year bucket, the median bucket. So That's a pretty critical bucket for you to invest, but do not skip your retirement, because very, very few industries, maybe the military, maybe firemen, cops, something like this, teachers, there's very, very few industries that give you any sort of pension whatsoever. And you might even have to pay for your health care. So you really want to accumulate money so you can be safe in your retirement. Buying a helicopter is one thing, but being safe so you can pay your bills and being secure and you have the choice to retire. Maybe you want to keep working, maybe you like your job, but if you want to retire, or you have a family reason that you want to retire, you want to have that choice. Excuse me. So rule of 72 is just something I throw out there for people to think about. And what that says is throw the number of years times the interest rate per year. And when that times that, years times rate equals 72, that's when your money doubles. So if you invest your money for 10 years at 7.2% per year, it's going to double in 10 years. If you can invest it at 14.4%, which might be challenging to do, it'll double in 5 years. Okay. So inflation, we all feel inflation. You don't need an explanation of this. And what it does influence? Well, I'd say the biggest influence is that you want your investments to, at a minimum, to beat inflation. When my kids were little, 4 or 5 years old, I sat with them. Oh, and by the way, I think I said this before, but my father, who's gone, was a wonderful man. But one time somebody in high school said, "Oh, I bought this stock." And I said, "What's that?" And I went home and I said, "What's that?" And my dad didn't really know what that was. So I didn't know anything about financial stuff until I was in my kind of like mid-20s. So this is why I'm explaining this to you, because you might be really intelligent people, but you might not have a great background in this. But anyway, inflation, when I used to talk to my kids, I'd say, pretend you had $100 and you put it in your drawer and you wanted to buy something that cost $100. 1 year from now, you take that money out of your drawer and you go to buy that item. Well, you still have $100. You didn't lose anything. But the item cost $105. That's inflation. So how does it influence what you invest? I think in general, some people are more risky than others. And I think you can't be risky with your mortgage payment. But in general, you would want to strive to have your portfolio, your diversified portfolio, ensure that it returns enough to keep pace with, if not exceed, inflation. So the prioritization, I kind of said this here. Emergency fund, then short, medium, and long term. Then the retirement fund, depending on how young you are, and the shorter the maturity is, the shorter the time is until you need the money, the more conservative it must be. And 4 or 5 years, I think if you need the money within 5 years, it cannot be in equities. So when you think about investment planning, you're thinking about it for yourself. You're also thinking about it for your family, maybe to buy a house, kids, 529 college plan. 529 plan is a plan in which you take after-tax money and you put it into, I believe all 50 states have it. And I think that if you put it into your own state's college plan, you get a deduction for your state income tax return. But the key point is that the money is never again taxed. So we all know how expensive colleges are. So any money you put into a 529 plan, and you can read this on the website, but you can compare states. I believe, for example, Utah, whether or not you live in Utah, Utah has a pretty low fee, and anybody can invest in it. If you happen to live there, you can take a deduction. But it's a good idea because the money grows and you can choose how the money is invested. And if you ultimately chose to take that money out and not have it used for the recipient, I think you can have that with a 10% or 15% penalty, which is not ideal. On the other hand, if the money grew 50%, maybe it's not the end of the world. But you don't want to put so much money in there amongst your budget that it's something you have to access later. The other thing is, say one of your children gets a scholarship and it costs anything, or does not cost anything. I'm quite sure there's provisions within the plan that you can change the recipient, the beneficiary, the person you donated to, or if you win the lotto and maybe you want to, and you can take you can take care of your kids, and maybe you can do this generationally. You can transfer this money to your grandkid. So buckets, right? Emergency fund, short, medium, long-term retirement fund. We put money in every month, and we fill them as we need to fill them. These are just some terms here. Certificate of deposit issued by a bank. It is typically guaranteed or insured by the FDIC up to $250,000. But this is an instrument. I don't know if they're shorter than 6 months, but they're typically 6 months, 1 year, 18 months, 2 years, depends on the institution, in which they say, "Hi, give us your money and we'll pay you this." Pretty safe up to $250,000. I'm pretty sure that's FDIC insured. That's the good news. The bad news is if you need the money, they'll give it back to you at a penalty. So that's no good. Or if rates rise and you have your money committed in there. So one thing you want to do or think about, if rates are so super low like they are now, although they're about to start rising, and you're scared of the equity market, which I don't blame you, and you don't want to buy a bond, like a 10-year bond, because you think rates are going to rise, I don't blame you. One thing you could do is you could put your money into the shortest CD. This is money you're not going to need, you're not going to have to access and pay a penalty for, but put your money into the shortest CD that you can find, and then just keep rolling it over as rates rise. Equities, that's stocks. Stocks can be individual stocks, can be ETFs, can be mutual funds. Fixed income, that's bonds. And what kind of bonds are there? There's government bonds issued by the U.S. Treasury. There's corporate bonds issued by corporations, which can be everything from companies like J&J, they're AAA, to lesser rated single A, to companies that are even high yield, which are called junk. Mortgage-backed bonds, which are you can buy bonds that are pass-throughs of bundled loans, or you can buy collateralized mortgage obligations, asset backs, the underlying asset of which is car loans or credit card loans, municipal bonds issued by, typically they're revenue bonds or GOs, general obligation revenue bonds, or municipal bonds that pay from some like a bridge or something like that charges a toll. And GOs are the general obligation of a municipality that it just has the ability to tax, and that's how it generates its funds, and you get receipt from those securities. They have different ratings. They are not all completely safe. Detroit went bankrupt. Orange County went bankrupt back in the 90s. So you have to do your work with these. One way to do it is to put it into a fund. But again, with fixed income and the current rates, with rates rising, I'm not sure if I would buy a longer maturity bond fund. One thing, well, you do get a tax advantage. One thing that people who live in a high tax area, they're called triple T's, triple tax free. It's a city, state, and or federal, state, and city, and you get the rate is lower, but it's not taxed by anybody. So that's just a math thing. Actually, you take your 1 divided by 1 minus whatever your tax rate is, and that actually is the equivalent rate for you. So that might make sense. Exchange traded funds are basically closed-end funds, and what they can change them, but they're static. It's a basket of investments, whether it's stocks, whether it's bonds, whether it's even a strategy within there, like a long short fund, or I think there's a new company that has a Bitcoin ETF. It's an ETF. It's a closed-end static fund. Like, again, it can make changes, but on a day-to-day basis, it doesn't change, and it invests in whatever it states it's going to invest in. So, dollar cost averaging. If you look at this, the vertical line, the price of some securities in our period of time between 5, 10, and 15. And we're going to invest $30 each of 5 periods. Okay. We're going to go here, 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 and here. Each of the 5 periods, we invest $30, but the money or the price of the security goes up and down. What dollar cost averaging says is Don't sit there and look at the price of the stock and wait for it to go lower or hesitate to buy it because it went higher. You can't time the market. That's the essence of dollar cost averaging. In period one, our security cost $10. So for $30, we bought 3 shares. In period two, it had gone up to $15. Doggone it, we only bought 2 shares. Period three went back down again to $10. So we bought 3 shares. Period four, it dropped to 5. So we were able to buy 6 shares. Period five, it went back up to 10. So we were able to buy 3 shares. So we invested $150. The average price was $10, which means we should have bought 15 shares. But because of dollar cost averaging, we bought 17 shares. It's not a trick. It just works because what this says is, and I just told you to invest every paycheck or every month, whatever, it removes the emotions of, geez, is it going to go lower? Is it going to go higher? Just buy it. It goes up. It goes down over the course of time. You're going to buy more than less. Excuse me. So look at this. I love this. And Jennifer and Courtney are really nice people. What this says is Courtney right here invested $2,000, okay, on a 5% annual return for 10 years. Then she stopped. Jennifer waited 10 years and then she invested $2,000 per year for 20 years, twice as long, twice as much money as Courtney. But at the end of 30 years, they have about the same. Actually, Courtney has an extra $600. The point is, this is what we talked before about the time value of money and the power of compounding. Because up here, Courtney's money, she put it in, the $2,000 per year at 5%, and it just kept growing, okay? Even though she invested half as much money as Jennifer, because she started earlier, they both invested the same amount for per year, but Jennifer did twice as much money, 20 years worth rather than 10 years worth. Because of the power of compounding, Courtney had the same or a couple $100,000 more at the end of 30 years. So what this really says to you is do it now, no matter how little, even $25, $20 a week, $50 a month, whatever you can do, just invest it now. And you might say, where? Well, that's going back to the buckets. If it's money you don't need for 5 or more years, I can't tell you I'm endorsing it, but it's not a dumb idea to just go into an S&P 500 mutual fund or ETF, which you can get from Charles Schwab, Vanguard, anybody, and just invest $50 a month, $25 a week, whatever you have. Now, the S&P 500, it's going to go up and down, especially in the short term. In my opinion, it will go up over time, and it's not a bad idea for that long bucket. Again, it's not for the shorter term buckets. Okay, so look at this. We talked about this sort of before, as far as, we have $1,000 and it earns 5%. Okay, so you invest $1,000 and you're just doing it once. Okay, just to illustrate a point. At the end of the year, it grows by $50. You think, okay, what's the big deal? It doesn't grow by $50 in year two. It grows by $52.50. Let's go all the way out to here. On year 25, your $1,000, it's not earning $50 per year. It's earning $161.25. So the message here is do it now. I guess I missed this point. Back in year 15, you're earning $103.95 instead of $50. And then by the time you get to year 24, it's $161. Okay. Look at this. Smart Saver. And Smart Saver, because Smart Saver saves money. They save for their future. The Smart Saver started at 22 years old. They put $2,000 per year into their account that earned 5% annually. Smart Saver over here is also pretty smart, but they started at age 45. Okay, so they're going to go for 22 years. The 22-year-old goes until age 42. The 45-year-old goes until age 65. They both saved for 20 years. They both contributed $40,000. Smart Saver, who started earlier, earned $183,000 in interest, whereas the one who started later earned $20,000. Why is that? because the person who stopped at age 42, the money kept growing. That's it. So this money on the left grew. They contributed for 20 years, just like the one on the right. But because they started earlier, the money just kept growing and the interest kept accumulating such that it's almost 4 times as much, right? Let's go to this one. I apologize. This is not too easy to read. What it says is, or the essence of it is, this is a document that says it talks about over a 20-year period. Now, maybe you wish I had $100,000, but let's just hypothetically say $100,000 if you had it. People go to cocktail parties, people go to coffee bars, people wait on the line in the morning for the bus, and they say, gee, I think the market's good, I'm going to go into it. Or, gee, I think the market's bad, I'm going to pull my money out. What this says is if you missed the 10 best trading days, if you stayed invested, okay, for the entire 20 years, your money would have grown to $324,000. That's pretty cool. If you made the decision, gee, I'm a little nervous about the market, I'm going to pull my money out. I didn't say change it. Changing it to something more conservative or more diversified is fine. But if you pulled the money out of the market and put it in cash, and you missed the 10 best days over a period of 20 years, your money only grew to 161,000, not 324, basically half. And if over 20 years, which is about a day and a half per year, you miss 25 to 25 best days, which who knows when those are going to be, your money grew, instead of to 160 or 324, it grew to 82,000. This is not a discussion over where and how you should invest your money. This is a comment that the money needs to be invested, even though you can invest it in ways that make you feel more comfortable, or we talk about sleeping at night. And this one here, this is a chart across the top. That's how much time we're talking about, anywhere from 5 to 40 years. And down the left here, $100 per month. Now, maybe that's a little too much for you. I don't know. But I circled 4% and 5%. By the way, let's sit back. Let's sit back and talk about $100 a month. Let's talk about a 30-day month. That's $3.33 a day. Okay? $3.33 a day. So if you took $3.33 a day and put it in a bucket, invested $100 a month at 5%, at the end of 30 years, it's going to grow to $83,000. That's kind of cool. Oh, by the way, if you happen to get 6% or 7%, which I think is aggressive, or you happen to wait even longer, it will grow even more. Let's go back to the $3.33 a day. I mentioned in the budgeting section, and I'm not going to criticize anybody's coffee. I personally don't care for Starbucks. Actually, you know what I do? I go to Walmart and I buy a gigantic can, $5, $6, $7, whatever it is. I don't know, lasts me a month. And I drink a lot of coffee in the morning. I don't know how long it lasts me, but my point is it doesn't cost $2.50 a cup or $3 a cup. If you can think of a way to save $3.30 per day, which would allow you to invest $100 a month, that's going to be $83,000 at the end of 30 years. Now, if you're like me and you drink 3 cups of coffee, you could come up with ways to save $10 a day. Now, $10 a day is $300 a month. That sounds $300 a month sounds like a lot of money. Does $10 a day sound like a lot a month? I don't know. Take the subway instead of drive, which you're taking your car and paying a toll, or maybe you have a friend you can carpool with and you chip in for gas, or maybe you get rid of your premium channel, or you have 3 of them and you get rid of one of them, or you get rid of your cable service and you just stream, or maybe you shop for a better cell phone plan. There's a gazillion ways to save $3.30 or $5 or $10 per day. And this could be the result to save for your futures. If you make a whole bunch of money, $200,000 a year, God bless you. You're probably off to a good plan. If you make less than that and you're like the average American, don't tell me you can't save. Well, I'm not your dad, and I'm not telling you what to do. I'm just saying if you want to increase your chances of having a secure retirement, figure out a way to save $3.30 a day. And you could source yourself by that alone $83,000. 5%, you can't just walk down the street and get that in a CD, but there's a number of ways you can figure out to get 5%. If you think that's too much, get 4%, you end up with $69,000. So I'm just going to go back here. I'm not trying to give you a headache. I'm going here to start. So we talked about all of these things to think about with savings and investments. Again, we're going back to our buckets, and we're going back to budgeting, which was part 4, which we actually did yesterday, but you hopefully are listening to it recorded. And we're taking our money and we're populating our buckets, and we're doing our emergency, short-term, medium-term, long-term, and retirement funds, or our categories rather. Again, the first thing you do is balance your income and your expenses such that the first expense or your first payout each month, each paycheck, is to your future, allocating that money amongst the 5 investments, and start investing like right now. I advocate investing without worrying about trying to find the top of the bottom of the market. That's what dollar cost averaging is. And this compounding growth chart is just remarkable. It shows how much your money can grow just by letting the interest do the work. Same thing here. The interest is doing the work. Okay. 2 smart people. All right. Just the earlier you start, the better it's going to be. And then, don't try to time the market. You can change your allocation if you're, more conservative, or you're more concerned, but don't sell and be in cash. And here, find yourself a way to save $3.33 a day, and you might be able to source yourself a nice little retirement nest egg. Oh, by the way, you never touch that. This is something you leave until you retire. Are there any questions? Okay, well, I realize there's very few people listening live, and hopefully many people are enjoying this tape. It's been a pleasure. I hope this has been helpful. I'm trying my very best. Thank you so much. Be well.